We are truly grateful to have you here with us. We know that your time is valuable. We know how bad traffic is in Atlanta. And so the fact that you're here means that this is important to you, and it's important to us too. At SignatureFD, our mission is to support you in using your wealth to live a meaningful life now and into the future. Our approach is centered around connecting purpose to wealth, deploying it deliberately in pursuit of your goals to grow, protect, give, and live. Navigating the inevitable ups and downs of the economic landscape while helping you stay focused on what matters most to you. Our mission tonight is to equip you with the knowledge and tools you need to make informed decisions that align with your vision for a life well lived. Does that sound good? That sounds good to me. If we haven't met yet, my name is Tim Maurer. I'm the Chief Advisory Officer at SignatureFD, and that means my life's purpose is to help ensure your advisors have everything they need to live out their lives' purposes, to deliver the high-touch, white-glove service that exemplifies our client-first philosophy. I'm an advisor by trade, and it's been my privilege to spend the second half of my 28-year career in advisor development, a journey that began when I got my chance to teach the college course I never got to take, the fundamentals of financial planning, at my alma mater, Towson University. I'm going to pause there for a second. You notice when I say Towson University, thank you for the sparse applause, but I've noticed I have a child who goes to the University of Georgia. And if I were to say, for example, that, let's say I repeated that sentence and I said, and it's been great to teach that course at the University of Georgia. It's just amazing. It's just absolutely amazing. I write a weekly column for Forbes and sit on the CNBC Financial Advisor Council, which brings us full circle, as one of our esteemed panel members was CNBC's chief international correspondent for many years. We'll introduce her in a second. So what's happening tonight? When you registered, you had an opportunity to answer a few questions. One of those prompts also gave you the chance to ask direct questions of your own. My job as moderator was to take your feedback and questions and use them as an outline for a productive conversation with our panel. So you should fully expect to hear your own voice in my questions. It's also my responsibility to posit any follow-up questions that our panel inspires through their answers. So, are you curious to get a quick glimpse of what you, as our audience, told us was most important? Yeah? Question number one was, are you worried about the impact of inflation, interest rates, and the presidential election on your money? And I don't think you're going to be surprised to see the answer here. 92% of you said yes, which begs the question, why are the other 8% of you here? The food, the drink, the good company, who knows? All of the above, he says. I appreciate it. Yep, that 92% of you said yes. Okay. Which of the following swings in inflation, high interest rates, and the presidential election is the most concerning to you? Drum roll, please. Drum roll, please. Thank you, James. All right, 58% said the presidential election. 22% said swings in inflation. 4% said high interest rates. Obviously, we've got a lot of fixed income investors here. Very pleased to see those normalized interest rates. I don't mind them at all. And then 7% of you said other. The other, I thought this was interesting, concerns that you expressed: rising national debt, the yield curve, reserve currency status of the US dollar, equity valuations, precision of published inflation data, capital gains rates, estate tax exclusions, anyone? Foreign conflicts, like the Ukraine and the Middle East and their impact on markets and the economy. And of course, the college football playoff. I'm a fan.
Some of us aren't worried about that.
Just a little bit less so, Tony. In addition to your questions, I've also asked the members of our panel to give me the questions that they think are the most important tonight based on their unique purviews. Speaking of our panel, we've got an amazing pairing on tap for you tonight. We knew it was important for you to hear directly from us, your wealth management team, to offer detailed answers to the questions that directly impact the resources that you have commissioned us to co-steward on your behalf. Therefore, our Chief Investment Officer, Tony Welch, is here, not only to offer his commentary on the impact of inflation, interest rates, and presidential elections, but to ensure it's clear how we are applying our research and insight to the management of your portfolios directly. If you've not met Tony, he's been with SignatureFD for 7 years, and he came to us with more than a decade of experience as an analyst at Ned Davis Research, one of the most well-respected independent investment research firms that serves institutions the world over. This means that you're in good hands, especially at times when emotions run high in the markets, because Tony applies a level-headed, evidence-based approach to everything we do and recommend from an investment perspective. While Tony has all the credentials of a high-level portfolio manager, including the Chartered Financial Analyst designation, he is also a certified financial planner practitioner and a comprehensive thinker, never divorcing his investment-specific insight from the broader planning that we are called to do for you, our clients. And please offer Tony your compassion, as his alma mater is Florida State University, where the Seminoles have struggled to maintain relevance in the broader college football conversation roughly since Tony graduated. Many years. Oh, sorry, I forgot Vicky was in the front row. Here is a recent clip of Tony's educating on the Schwab Network.
So let's bring in Tony Welch to help us take a look at the fundamentals behind the technicals, the Chief Investment Officer at SignatureFD. Tony, great to have you back. Thanks for sharing part of your Wednesday morning with us. Still expect that the Fed's going to cut rates in June?
We're still heading towards a June rate cut. It's going to be called into question a little bit today. I think it's not going to take a lot to get those median dots down from 3 cuts to 2 cuts this year. But I think you'll have a PCE inflation number and a job market that lines up with a June cut still.
Yeah, I asked because we have seen a bit of an increase in inflation, right? There has been quite the pushback in terms of where we were as far as expectations into the end of last year versus where we are as we head into the middle of March, obviously. And then the other reason I ask is because
All right, you get the idea. Tony's really smart. It always amazes me. Every Monday morning, we have this call at 8:30 for the whole company. And Tony comes in, I'm assuming he must have had like 4 cups of coffee because he's ripping off like all these factors about what the market did the last week. And I'm just barely waking up and trying to get my second cup of coffee. In addition to Tony, we thought it was important to invite someone with an external perspective. So I'm thrilled to introduce you to Michelle Caruso-Cabrera. Michelle was the first Latina anchor at CNBC, where she still serves as a contributor. In her more than 20 years at the network, she served as chief international correspondent and co-anchor of the program Power Lunch. As our discussion tonight will range into the impact of geopolitical events on the markets and economy, we're fortunate to have a panelist who has reported from places like Iraq, Iran, Ukraine, Venezuela, and other world hotspots. But the sweet spot of her expertise, however, resides at the intersection of economics, policy, and politics, where she can dissect major world events and translate the impact on global markets. While she remains a CNBC contributor, she took the bold step of leaving her full-time post there in 2018 to pursue an interest in corporate governance, and she is currently on the board of directors for Wendy's and Del Real Foods, as well as the president of the board of Ballet Hispanico, the nation's premier Latino dance troupe and organization. Although you've likely seen her on TV before, here's a quick glimpse of Michelle in action.
More registered helicopters in Sao Paulo than any other city in the world.
Once this platform is out at sea, 200 workers will live on it for 15 days at a time. Only 15 companies were traded here.
Now there are more than 40.
Bernie Madoff has been arrested. Pretty tough to breathe. At some point, there's a lot of tear gas in the air. They're living in tents. There's very little running water. Mark Cuban is here. We know that for Hillary Clinton. When it comes to Donald Trump, he's brought Bobby Knight.
Mexico has free trade agreements with more than 40 countries.
The North Koreans committed to the complete denuclearization of the Korean Peninsula. I'm Michelle Caruso-Cabrera, Davos, Switzerland. Paris, France. Havana, Cuba. Kiev, Ukraine. Caracas, Venezuela. Nicosia, Cyprus. Athens, Greece. Northern Iraq. Brussels, Belgium. Tehran. For CNBC, I'm Michelle Caruso-Cabrera in New York.
How about that? Would you please join me in welcoming Michelle Caruso-Cabrera and Tony Welch to our panel this evening? Okay, before we dive in, I'd like to address the elephant, or donkey if you will, in the room. Politics and policies are tricky topics to address well. We're all human and we all have our own opinions, but unlike the politicians who aim to craft their messaging to sway our opinions and secure our votes, our jobs as advisors are simply to inform and educate on what the reality is, not what we may wish it to be. Therefore, when we have our advisor hats on, we're taking our other hats off, whether they be red or blue or purple or any other color. All right, let's jump in with both feet. Each of us has chosen to address one of your biggest questions with an opening statement of sorts, supported by a visual. Therefore, we'll navigate the remainder of our time as a free-flowing conversation more than a presentation. For my part, while we will return to this subject from several different angles, I wanted to address the number one questions that, according to you, are on your minds at the very highest level. And that is this one. What impact will the presidential election have on my money? Of course, we're not in the business of prognostication, but we do have a great deal of history to look back on. And I wanted to show you a couple visuals here. This one shows you the market's performance broken down by the party of the president at that given time. Now, as you take a glance at this slide, what do you notice as a relative consistency throughout, up and to the right? Now, if we zoned in, you'd remember the crash of 1987. You'd remember the 82 to 2000 crazy bull market run that ended with the tech crisis, right? You would remember 2008, 2009. You'd remember the impact of COVID-19 and many other things that have happened in addition to these presidents. But we do see that over that long stretch, up and to the right, as they say. Now, this one I thought was particularly interesting as well. If you look on the left-hand side here, what you're seeing in green is if you stayed invested throughout the entire time. What you see broken down below that is what you would have earned if you would have only invested during your particular party's president or your preferred party's president. And what you see here on the left-hand side is the performance of the last 10 years. Again, note green is the one where you are staying invested. But the massive difference is the one on the right-hand side when you look back over the last 70 years. Look how much money you left on the table. If my math is right here, it's about $1 million with a $1,000 investment that was left on the table by getting in and out of the market based on who was president at that time. Now, we're going to break this question down differently and in many different ways, not just looking at the president specifically, but what does it look like depending on the party that may be in power and in the House or in Congress. And we're going to take a look at that as well. But that, to me, I thought from a high-level perspective is particularly compelling. Now, Tony, I know you have a lot to say on this as well, but the question is also baked. If not the presidential election, then what is driving markets right now, and how does this chart help us understand that?
So I was doing client events in North Carolina 2 weeks ago, and I was doing Raleigh, Winston-Salem, and Charlotte. And at all three of those events, there was alcohol, which I find funny because we're not supposed to drink and talk about politics. But the advisors keep throwing me to the wolves, and we have to attack these things. But I'd like to just kind of start with an economic perspective. So going into the year, last year, going into 2023, I've never read so many research reports that said we're about to go into a recession in my life. We leaned against that. We favored risky assets in 2023. We've even more so favored stocks in 2024, leaning against the consensus that there's going to be an economic recession. This chart here I really like because it tells us two important things for tonight. The first is what's going on with the presidential election. The second is what's going on with the economy. So what this chart is it's real disposable personal income, year over year change. So this takes into account wages, it takes into account Social Security, and it strips out inflation. And you can see that those big spikes up were COVID stimulus. The big drop down, the biggest drop down we've ever had in purchasing power happened in 2022. Since that time, in 2023, 2024, real incomes have been rising, and they've actually been rising faster than average. Normally, when somebody would ask me, they would say, who do you think is going to win this election? If I look at an economy that's growing over 3%, an inflation rate in the 2s, an unemployment rate at 4%, and a stock market that's up over 20% for the year, I would say the incumbent party is going to win the election. Donald Trump's leading in the prediction markets right now. And I think this chart explains a lot of it. I can think back to another time when the market rallied and the incumbent lost. It was Jimmy Carter. So what had happened was he was getting penalized for cumulative inflation. And I think that's what's explaining a lot of what you can see in the election today. Now, as for what's driving the economy, when real income is rising, and it's rising about 3% per annum right now. So that's income minus inflation. You're getting an extra 3% spending power right now per year. Never underestimate the American consumer to do what we do best and consume. My family is a phenomenal consuming American family. I just got back from Walt Disney World. We were just in our executive team meeting. Somebody just came back from Denmark. Somebody was on their way to London. We're traveling. We're still doing these things. And real incomes are supporting it. And it's supporting the consumption side. And we're probably going to print a pretty fast GDP number for the third quarter. And we're tracking to over 3% gross domestic product right now. So I'll leave it at that. There's a lot more to say. But I think it's an interesting dichotomy between what's happening in financial markets and the economy and what's happening from an election perspective. And I think this chart does a good job explaining both of those.
So Tony, real quick follow-up. Is it that while many of us, and especially people like you, are looking at these types of charts and thinking about this data on kind of a macro level, most people are just considering how it feels, how expensive things feel right now?
So absolutely. Inflation shocks. So when we think about investing, we don't think about levels as much as how fast things happen. So when you get and the reason for that is when you get a shock. So an inflation shock like we had in 2022, it takes a long time psychologically to recover from that. If you look at the trend in real income right now, we're back on trend. So we're back on trend to where we would be even post the inflation shock. People have approximately the same spending power that they had before COVID. But it takes a long time to psychologically get used to a gallon of milk being that price, a carton of eggs being that price, gasoline being the price that it is. Housing is a big problem in terms of affordability. It takes a lot of time for that to work kind of through the behavioral system.
Yeah, real disposable personal income. Okay, Michelle, your favorite slide that you wanted to talk about. Let's take a step beyond our borders for a moment to get a glance at how the U.S. economy is faring relative to other economic powers, such as Europe and China. China in particular has received a lot of press and is regularly used as a punchline by politicians on both sides of the aisle, interestingly. For more than a decade, there's been a presumption that this emerging economy powered by 1.3 billion people could be on track to overtake the U.S. economy. Is that what the data suggests?
Not anymore. I really love this chart. So this is produced by Rhodium, which is one of my favorite firms for Chinese research. They read a lot of the actual stuff in Mandarin, in the written Chinese language. And what this shows is each of the corresponding countries' percentage of global GDP. And what you'll see is that the United States, the largest economy in the world, is still gaining share in global GDP. It shouldn't be that way. The law of large numbers should make that extremely difficult for the United States to do that, and yet it is doing that. Why is that? Europe just can't get out of its way. China is not being truthful about their numbers. The China official is the yellow, but the rhodium actually goes through the underlying data, what feeds into the GDP numbers, and it's nowhere it's true. They have peaked in terms of their share of global GDP. They'll still grow, but they're not going to grow at the rate that a lot of people had expected when they were doing all their, modernizing their economy, liberalizing their economy. They've now reintroduced, the Chinese Communist Party into many of the businesses, state loans. All the banking system now drives all their loans towards large state-owned businesses, not to the private sector. So the United States, where it's a tense moment, we could have some turbulence, but in the long run, we are still the most dynamic economy in the world. China is shooting itself in the foot right now, making a lot of bad decisions. And Europe, this is the way I think about Europe. In the United States, in the United States, everything is permitted until it is prohibited. In Europe, everything is prohibited until it is permitted. So, 2008, the US economy and the EU economy, the European economy, were the same size. $14 trillion. Today, the US economy is $27 trillion, and the European economy is $15 trillion. Germany's smaller than it used to be because it's made very bad decisions about energy. France has barely grown. These are the two most important economies in Europe. They just have very different attitudes than we do. Just ask them, and it it helps us. So we're going to go through a lot, I think, but you should feel, I think, optimistic about the United States and what our DNA is in terms of our entrepreneurial spirit, our go-get-'em attitude, etc.
Yeah, Michelle, it's interesting too, looking at the blue line for China. And one of our guests tonight had asked the question, how much can we rely on the data that is coming out? Not just in China, I'm asking, what about on the home front?
I have a lot more confidence in U.S. data than I do in China. I mean, Chinese are straight up lying. They'll say GDP grew this amount, but cement sales fell 40%. When your economy is based on real estate, there's no way that your GDP is growing at a rate of 4 or 5%, and you're telling me that your cement sales are down 40%, right? Yeah. I have more confidence in. I mean, you can criticize the way we measure inflation. Let's exclude food and energy. Well, that's what a lot of people buy. And to your point earlier about inflation, I think there's a lot of penalizing going on for inflation. I covered Latin America. My first job out of college was at Univision. Leaderships tumble over inflation. I mean, people get so angry. The rioting that would happen in Latin America when they were having massive inflation. And in fact, in Argentina, which was in the last 10 years was running at horrendous rates of inflation, the population got so mad, they elected a guy a year ago who carried around a chainsaw promising to cut the federal budget of Argentina. Politicians never run on cutting spending, ever. But in Argentina, it worked. And do you know what he did? In 1 month, he cut the federal budget 30%.
Wow.
In 1 month. Inflation was when he came into office, running 1% a day. It's now running 2% a month.
Wow.
So
that's a serious chainsaw that guy had. All right,
totally.
Now, Tony, so it may not be as much of an issue when it comes to our numbers of are we just being told the truth? But what is the truth that is being told with those numbers? And inflation is one of those measures in particular that I think there's often been a disconnect between what the number says and what it actually feels like on the home front because of what it measures. What are the types of data that you are looking at most closely that do matter to you?
First thing, I want to take a step back. The other thing that we can gain from this chart is I wanted to give one more kind of economic number for you guys. 167 trillion is the number. So remember, Michelle just said 27 trillion is the size of the U.S. economy. Do you want to guess what 167 trillion is? Household net worth. Thank you, James. So by
James read the briefing.
By being a participant in all this affluence, we now have built $167 trillion in net worth in the United States. And one of the things when I hear kind of these persistent calls for recession is somebody has to explain to me what's going to get these folks to not spend when they have $167 trillion in net worth.
Yeah.
Now, in terms of what I like to watch for inflation, I mean, number one, no inflation calculation is maybe going to be perfect. We watch a lot of real-time measures to try to get ahead of what CPI or PCE inflation is going to be. And actually, in a lot of those cases, some of the real-time metrics are running closer to 1% inflation right now. So, in terms of the government data, I think it's pretty good. The way some things that are calculated can be a little bit fudgy. But I like to look when you think about, are we going to have another wave of inflation? I think that tends to be people's fear. In the 1970s, we had 2 waves of inflation, and we absolutely could have another wave of inflation. But when I look at the data today, it just simply doesn't support a second wave, at least starting anytime soon. And I think the data that is most important is I look at what's happening from a wage perspective. So wages are still running at a fairly robust 4% rate, but we've had a phenomenal trend of productivity starting to come into the U.S. market here. That's happening for 2 reasons that I can see. One, investment in, you can call it AI, but it's just productivity enhancing investment and technology spend. And then the other is people aren't leaving their jobs anymore. So when you're not leaving your job, you can get trained and become productive. In 21, 22, people were just going down the street and getting another job. Now people are, they're staying put more. Yeah. So you've got 4% wage inflation, you've got about 2% productivity growth, and that supports an underlying inflation rate of about 2%. Okay. And that's where we are today. That's kind of the dichotomy today.
Okay, now I want to come back to this chart for a second, Tony, because when we look at this, we're all like, all right, U.S., we're doing it, we're winning. And that's called domestic bias. But we still do believe in the benefits of diversification and international exposure as well. So talk about how we reconcile that. How do we reconcile our own domestic bias with the need, we believe, for comprehensive portfolio structuring and international investing as well?
Yeah, it's a great question. I think Michelle's going to be a great addition to this if you want to bolt on at the end. But I think, listen, we've been overweight in U.S. equities. We're riding this wave. We do believe this has been the best place to invest capital. We've put more money in the U.S. market than international markets, even relative to benchmark weightings. But we want to maintain some diversification in international, and one of the chief reasons is there are long-running secular trends that favor one region over another, and those trends can and do change through time. We're on about a 15-year bull run for U.S. markets, and what comes along with that is I think I saw somebody had a concern over valuations. I'm not concerned about valuation today. There's other things to kind of offset that, but valuations are pretty expensive in the U.S. And I compare that to international stocks. International stocks are about half the valuation of U.S. stocks. So you start to think to yourself, well, what's priced in to the stocks here versus what's priced into international stocks? Can you get positive surprises along the way that boost these things from low valuation levels? Because to me, all valuation is a sentiment indicator. It just says, hey, how optimistic are we on U.S. stocks and how pessimistic are we on international stocks? And then you're ripe for negative surprises on the one hand and positive surprises on the other. Now, there could be good reasons, and probably are good reasons, the U.S. should have a valuation premium to global markets. We've got the best companies in the world here, very capital light, technology driven companies that are just cash cows, and they should command a pretty good valuation. But just today, I was looking at U.S. sectors, every sector, so 11 like energy, materials, consumer discretionary, technology, financials, industrials. Every sector in the U.S. commands a premium to every international sector right now. So it's not just because we have tech companies. The capital has flown here. The optimism is built up. We're overweight the U.S., but you want to have some dollars in lower valued areas as well to diversify the portfolio.
All right, Tony. So, like, this is not a debate, and I'm not a fact checker, but every once in a while, Tony starts throwing out these economic terms that I do think need a little bit of explanation personally. So, you mentioned secular trends at one point. Secular trends versus cyclical. Talk a little bit about what you mean by that.
A cyclical cycle is like a bull market or a bear market that we all know and love. Like 2022 was a bear market. 2023 to 2024 is a bull market. That's what we call a cyclical cycle. They last from a period of months to 3, 4, 5 years. A secular cycle is a long-term trend that encapsulates several of those cyclical cycles. And that's where we've really been since the financial crisis. We've been in a secular bull market in particularly large cap US stocks. We've been in secular bear markets in a lot of the international spaces where they've just kind of persistently underperformed through that time.
Great. Michelle, I would love to hear from you on international investing too.
A couple of things that come to mind as you're talking about first secular versus cyclical. You know, one of the ways I think about the world is that, you know, there were two trends that were true for 30 years straight. China was going up, US interest rates were going down. Those are reversing before our eyes, right? And so that's going to cause changes and expectations, et cetera. I'm very still bullish on the United States. I spend a lot of time with European and Latin American CEOs, and they are, you know, depressed by how overregulated they are. They are far more risk averse than US CEOs. Chinese CEOs are very depressed about their inability to access capital. That being said, even when you have those negative situations, you can get some breathtaking, ferocious rallies like we saw when China decided they were going to attempt a stimulus, right? So those things. So you want to have some exposure from when those moments happen. Absolutely. And also just to be diversified in case we have an issue in the United States. It's particular to us, even though when we sneeze, everybody else catches a cold. Yeah.
Yes, indeed they do. All right, another big discussion in the arena of international economies is the word tariffs as it relates to. So could you talk a little bit about how do tariffs work? And when we talk about tariffs in particular related to China, what's the actual function that's taking place there?
Yeah, so tariff is simply, you know, you produce that, you want to sell that car for X. Well, we're going to make sure you Chinese EVs, we're going to put 100% tariff on that. So it's going to cost 2X of what China had hoped to sell it. Right? That's how it works. It's different than quotas. We used to say, okay, we're only going to allow certain amounts, and that would protect our home producers. But tariffs are more efficient. They help raise tax revenue, et cetera. So that's the preferred method of protectionism. And I don't mean that in a pejorative way. It is a protection of some measure. You know, we obviously have a candidate who is much more eager to impose tariffs. But that being said, again, if you spend time with a lot of overseas CEOs and members of the leadership, their belief is that the United States has become much more insular, that protectionism is true for both parties, that industrial policy in the name of national security will continue, and that, you know, we all have to get used to it, and they are getting used to it. So that's now I've been in the IMF meetings for the last week, and there's been a lot of discussion with some members of people who are advising former President Trump, and they're talking about the way they would impose tariffs would be no shock and awe. It's not going to be a big announcement in January. Instead, what they would do is forewarn, jawbone, warn everybody, phase them in. And I think it's also a big negotiating tactic as well to try to extract a better trade deal out of other countries that the president feels has not been fair to the United States. The other thing that they're talking about is trying to use it as a way to bring like-minded nations together to stand against China. I'm talking more about what would happen if there was a change, because you know, if Vice President Harris wins, I think we get a lot of continuity in terms of what would happen.
And so in that situation with the tariff, it's imposed. Who is it imposed upon? Who's actually paying the tariff when it comes? Is it the importer? Is it China? Who's paying
the U.S. consumer will pay more, right? Because we're gonna all goods become more expensive.
Yeah,
it's that simple. Absolutely. The one thing I would say is, a lot of people have their notion about tariffs from Ferris Bueller's Day Off. Do you remember that scene where Ben Stein is and he's explaining why the Depression was so bad? The one thing I would say is that I think a lot of people conflate that with the fact that we also know that in the 30s, the central bank wasn't doing what it was supposed to do or what it would do now, right? It wasn't the lender of last resort. And it was allowing banks after bank after bank to fail. So I think a lot of people conflate the tariffs with that. And you'd have to separate out, okay, what was the central bank doing? Tariffs are not going to be good for an economy, right? But there will be winners and losers. There may be people who get better paying jobs as a result of it. That would be the goal. But we would all pay more.
Yeah. All right, Tony, when it comes to the words like isolationism and protectionism, another area where that comes into play is foreign conflicts. And we've seen that, right? A lot recently, the Ukraine and the Middle East in particular. What impact do those foreign conflicts have on the markets themselves?
You just want to show the first chart that shows up and to the right?
Right, exactly.
Keep going back to the same chart. It's just like one chart for the whole.
So, I mean, the reality on we're running an investment portfolio, so there's a human element to all of this stuff that we acknowledge. But the reality is they're all different. They all have their own impact. So, in the case of like Ukraine, Russia, we saw an immediate impact in agricultural commodities, particularly wheat, some energy impact. Stuff like that. But, they were pretty efficient at finding different ways to get their wheat out onto the market, right? And now wheat prices are back to essentially where they were, so these things do tend to be transitory. And there's
What's
I
that
should
one
just
mean,
retire
Tony?
that word.
I'm just gonna
Nobody
have
should ever say transitory.
Buzzer, so every time he uses
but they tend to be fleeting. Generally, conflicts tend to be sell the rumor, buy the news events, honestly, where, by the time, I can remember when Russia was stationing troops, that's when the markets were going in a tizzy, not when they actually invaded, obviously Israel, Iran, that could have an impact on energy markets. But we have to remember the U.S. is now the largest producer of crude. Iran is essentially a swing producer now. And it's the U.S. economy is much less old energy intense than it really has ever been. So again, potentially fleeting from a stock market perspective. The one that I do acknowledge to people I think is a concern is China-Taiwan. Mm-hmm. And I think it would be foolish to not be concerned about an impact to the semiconductor space. Because you kind of look at back, oil disruptions in the 70s kind of led to a lot of the inflation and economic trouble that we saw. Well, the world doesn't run on oil anymore. It runs on semiconductors. So, so anything that happens there. But, look, just saw a headline come through that Taiwan Semi's new factory in Arizona is doing a bang up job, right? So some of this kind of reshoring of things and the supply chain, tightening up the supply chains is trying to get ahead of anything that may happen there. But if you had something overnight between China and Taiwan, I think that would be a problem.
Michelle, you've spent a lot of time in that region.
Yeah, it would be devastating. War over Taiwan would be devastating. The whole national security establishment spends all of their time thinking about if and when that could happen. And you have people who believe it will happen in the next 6 months and people who say it will never, ever happen. It's impossible to invade Taiwan, but they could do an physical embargo like we did against Cuba way back when. So that is a big concern. The other thing I would say is that if the Israelis were to attack Iranian oil facilities, that could be problematic. Now, all this week, we are being told that the administration has convinced the Israelis that they should stick with ballistic missile production facilities, drone production facilities, and not attack the oil industry. Because even though we are reliant, oil is fungible, other people in the world rely on it, and that Iran would likely take retaliatory action against other oil producers in the world, and that would be very bad for our national interests and for global national interests. So the other thing they've been trying to do is convince the Israelis to wait till after the election. But the expectation is that they will not, because Netanyahu, of course, would have a preference for President Trump over VP Harris. So he's not necessarily going to do anything to help the current administration at the moment.
Yeah.
So
I want to take a step back and summarize the last couple points. There are implications to all of this stuff we're talking about. There are short-term implications in particular. As we've seen, the long-term implications, they mellow out those numbers. And the biggest challenge that we have as investors, too, is remember this. If you try to time any of these events, you don't just have to be right once, you have to be right twice, right? So you have to be right when you sell, and you have to be right when you buy back in. Tony, could you talk a little bit about how much of the market gains we enjoy come in spurts and are extremely unpredictable when we have these recoveries?
I mean, market timing is nearly impossible, right? But I think what would be kind of an interesting thought exercise is you go back, like, because people kind of expect, like, the results of the election, there should be opportunity, or, you know, there should be some investment opportunity, you know, on November, what's the election? The 5th, 6th, right? Yeah. The 5th. So 6th. On November 6th, I should be able to go into the office and, you know, hit buy, and I've got this opportunity because Trump won or because Harris won. And markets don't work like that. As a matter of fact, as Trump has been rising in the predicted markets, certain sectors have already been starting to price in a Trump victory. In fact, you know, we've seen bond yields rising. We've seen 5-year break-even inflation rising. So Michelle talked about tariffs being potentially the consumer paying more. You know, the markets are already starting to price in that result, because they're looking at early voting tendencies. They're looking at predicted markets. So they start to price this stuff in well in advance. And the thing that I can think back to was, I wasn't at SignatureFD in 2016 for the first Trump election, but I do remember he was elected, and I remember writing about Trump trades. And one of the trades I wrote about was energy. This guy's going to deregulate the energy sector. This is going to be so good for these energy companies. No red tape. Well, what ended up happening was they drilled like crazy. At the same time, tariffs were starting to kind of do a little bit of work on the manufacturing sector. So some of the demand was coming down for oil. So you had a ton of supply, lesser demand, crashed the oil markets, and energy stocks were atrocious. So a lot of times, even if you think you have an informational edge because of a candidate, you don't. It doesn't end up playing out that way.
The Mexican peso got hammered upon his election. Hammered. People thought, oh my gosh, you know, he's going to pull out of NAFTA, etc. Wilbur Ross convinces him to stay in NAFTA, and they do the USMCA. And the Mexican peso is one of the best performing currencies because of onshoring, et cetera, right? It's extremely hard to predict what the outcome is necessarily going to be for, I think, either one of them.
Yeah. Michelle, one thing we don't have to predict is where the national debt stands today. And another one of our guests wanted to hear our thoughts on the impact of our spending, including foreign aid, and the impact that has on our national debt. What are your thoughts on the current state of our national debt, as well as the short and long-term implications?
Well, we've got a debt level akin to as if we were at war, except it's peacetime. I mean, the spending levels are crazy. We've got 100% debt to GDP. That's off the charts. You'd have to go back to World War II for that kind of spending. It's very negative. You know, I was in Greece the morning that all the elderly people woke up and found out that their pensions were going to go from 1,500 euros a month to 900 euros a month. That's what happens when a government spends too much and doesn't take steps early enough to deal with the situation. And then bam, overnight, people suffer. We're not there yet. We have a very powerful economy. We could grow enough to overcome our debt situation. But it's highly problematic, and politicians almost never want to do anything about it until, you know, inflation's running at 1.5% per day, like in Argentina. The other thing I would say is that it's the one, you know, fly in this ointment about how positive things are is that it could lead to a permanently higher cost of capital for the entire world. You talk to overseas business people, and they'll tell you, the whole world's interest rates live off U.S. interest rates. And so if your interest rates are rising, my interest rates are rising. I remember meeting with the the head of the Chilean central bank many years ago. He says, yeah, people always ask me, where are Chilean interest rates going to be in 2 years? And I tell them, where are U.S. interest rates going to be in 2 years? At 5. That's it. So we could, the other thing that was so interesting is listen to this. In the IMF meetings, Treasury has been talking to a lot of the bankers within the fixed income world, and they have to start really managing issuance like the way the Italians have for decades, right? So they're comfortable with the issuance calendar until about the end of 25. But then there's an issuance gap of $3.4 trillion. In other words, they have planned a certain number of auctions, 30-year, 10-year, et cetera, T-bills for X amount. And now they realize they need to plan for $3.4 trillion more in issuance. They're starting to think, okay, what other products can we offer? Should we start adding interest rate floaters? And what percentage should be coupons? What percentage should be T-bills? Right now, 22% is funded by T-bills. They like it to be 15 to 20%. So it's a real, it's a place that we haven't been. And we're going to need really good people in Treasury to figure this out. And at some point, really take stock and control ourselves in some way.
As a financial planner, I tend to think that whether it's a household or an institution, you should spend less than comes in. Yet, when you look at the history of the United States, we were effectively born with a national debt, right, to pay off the Revolutionary War. So how is it that historically, we've had a national debt for the majority of our history? How do we get out of that being a scary problem?
Well, yeah, we had a lot of debt and people went hungry and we didn't pay Civil War soldiers. I mean, there are costs, right? So you can either inflate your way out of it, which is one way to do it, or you can cut spending pretty dramatically. And you can either do it in a careful way, or you can be forced to do it overnight and tell elderly people they're not going to get the Social Security that they wanted.
Good luck doing that. Telling a whole generation, right?
Yeah.
I'm not sure that's particularly politically expedient.
No, but you read the surveys, young people don't think they're going to get Social Security.
I noticed that.
Yeah.
I noticed that.
They may be right.
Yeah. Tony, one of the major contributors to our national debt is indeed government stimulus. Let's turn our gaze for a moment from the national debt to the impact of government stimulus on the stock market. And I've got a chart for you here too, buddy. You're going to be really excited about this one.
I was going to say it must have a lot on it if I'm going to be excited about it. Good luck, guys. I can sum this up really quick.
That'd be great.
Both of these people want to spend money. All right. They want to spend a lot of money. A couple things, though. I mean, just go back to the deficit a little bit. People ask me all the time, I'm taking an investment lens, and they say, are you worried about the deficit? And I say, well, no, I'm not worried about the deficit. I'm worried about what happens when we decide to do something about the deficit. So we have to remember that the deficit, Uncle Sam's debt, is another person's income. When the deficit's widening, the stock market's done better than average. So a widening deficit hasn't necessarily been negative from an investment perspective. I also think the numbers are what the numbers are that Michelle cited. The deficit's going to get better. If we don't do anything, the CBO estimates are probably wrong for what we're going to have for the deficit in the next 12 months. They're estimating about 3% tax receipts. There's going to be about 10, 11% tax receipts given, the market being higher. Deficit's probably going to be somewhere in the range of $300 to $600 billion less than what they're currently forecast, almost no matter who wins next year. But I think what's important to note is that both of these candidates do believe in fiscal stimulus. And again, markets tend to perform well when the fiscal side is stimulating. Markets perform well when monetary is easy. So the Fed, they cut interest rates in September. They want to cut interest rates some more. And fiscal stimulus is probably on the way. Now, it's questionable. These are all just campaign promises, by the way. It's questionable how much of this is going to get done, right?
We had divided Congress.
You could have divided Congress. Even in a wave election, you're starting to see headlines out there that talk about our net interest expenditures are higher than our defense spending. That's going to get people's attention in Congress. So I think neither of these candidates, I don't think they're going to end up with a blank check to just blow out the deficit from Congress. But I think it's something that kind of has the markets back until it doesn't. You know, if you take the path of austerity, Michelle spent some time talking about Europe. And I think about Europe post-financial crisis, and they took the austerity path and we took the spending path. And our economic growth has been about 3% a year. Their economic growth has barely been 1% a year. They're in recession every other quarter, it seems. So there's big differences there in government spending.
Yeah, I would add that they didn't have much choice, right? Because they didn't have the money and they didn't have the borrowing power, right? Your Italian interest rates start rising, they can't pay pensions, right? We had a lot more capacity. And we still do, but at some point it does become a tipping point. We have a natural governor, right? It's the 10-year yield. I mean, you go back to when the first Clinton wanted to do a national healthcare plan, and the bond market started to rip. And that's when they came up with the term bond vigilantes by Paul Yardeni, who you see on CNBC all the time. And James Carville was like, wait, we have to pay attention to some bunch of guys yelling in a pit about whether or not we can. Yes, you do. Actually, you do. So there'll be a natural governor on what happens.
Yeah. That reminds me of one of my favorite interviews of all time. It was actually days before the Trump-Clinton runoff, and I interviewed James Carville and Mary Matlin together.
So interesting.
Whew.
Wow.
That was something. There were some great clips.
He's a great interview.
He really is. So she's fantastic. Tony, this brings us to the discussion of interest rates. One of our guests asked this question: is the Fed reducing interest rates a response to a recession threat or just falling employment? And is there a difference in how the markets will respond to a recession versus good GDP with higher unemployment?
Couple things. So one, the Fed has a dual mandate, and I actually think they believe that. You know, there's a lot of Fed haters out there. I think Jay Powell's done a pretty good job, I think. And he has a dual mandate of stable inflation and full employment. Inflation has a 2 handle on it and has been heading lower all year. So they feel like that risk is not currently outweighing the labor piece now. So they're trying to get ahead. We're currently in an economic expansion, but not everything's perfect. So one of the things I look at how many industries are creating new jobs. Well, it's only about half of them right now. So about half the industries out there are holding up job creation right now. In a very healthy economy, it'd be all of them. So you kind of, and the Fed looks at data like that, and they say the labor market is softening. And I can promise you, they don't want to be the Fed that got it wrong on inflation and then got it wrong on the soft landing. So they're trying to at least ace the landing in this part right now. And then in terms of interest rates, the Fed thinks the normal policy rate is 3% on kind of the Fed's target rate. If things are normal, they think they should have a 3% borrowing rate.
How does that translate, though?
The bad news, so the bad news is you all might have noticed that the Fed cut and 10-year interest rates came up, right?
That's the governor.
The bad news is that the 10-year priced in an interest rate cutting cycle a long time ago. So, you know, it already moved well ahead of the Fed, and now the Fed's just getting to where the longer bond thought that they were going to go. In a normal environment, a 10-year treasury would trade a little over 100 basis points above the Fed. So if the Fed's at 3, we can expect a normal rate of around 4, 4.10, something like that. Well, we're around 4.20 today. So you're in and around a normal rate. That's the bad news. If you're like me and you stupidly got rid of a low interest rate mortgage and moved in to a high interest rate mortgage, you probably are not going to get a chance to refinance unless we get an economic recession. Because at that point, the Fed's going to do more than the market is currently pricing in.
Yeah. So then I'm coming home to explain to my wife after buying this house in Roswell 5 months ago, like, babe, I got good news, bad news.
The financial planners in the room.
The good news is we can refinance. But let's talk about interest rates for a second too, because the implications to us as investors are really quite substantial. Do you feel like we're in a normalized situation right now? And what are the implications as it relates to the equity investing that we do as well?
I think it's telling that one of the least concerning things to the folks in the room is interest rates.
Yeah.
I mean, a 4-year 10, like 4% on a 10-year rate, like that's fine.
Yeah.
The economy can function fine like that. That's not much competition for equities. That's a fine long-term interest rate. I don't think that that's really an issue. So I think you've seen a normalization. A lot of things are normalizing right now from all the wackiness. I mean, I showed that real disposable personal income chart. There was a lot of things that got out of whack because of the pandemic and have been normalizing, and interest rates are getting back to a place where they're more normal. And honestly, if I'm a bank lending 30-year money for a mortgage, I think 6% is probably pretty fair.
Yeah, they're okay with that. Well, Michelle, an even greater concern for our group tonight is indeed inflation, even though these two things are interconnected. And one of our guests raised a question that I loved. They said, it seems that companies have taken advantage of economic crises by passing on their costs to consumers during a downturn, thereby preserving their profits. When the economic environment rebalances, the increased costs tend to stay elevated. Is this something people are just perceiving, or is there truth to this notion of some form of price gouging? And is there governmental oversight for this?
So the input costs are still high. The same way when you go out to the supermarket, whatever you do, and you see that, okay, maybe the pace of the growth of the pace of inflation has slowed, prices are still higher than they were in 2019. Well, that's true for input costs as well, right? So no, I mean, how are you going to identify gouging? How do you define it? I think it's extremely difficult to do. Yeah. Companies are dealing with higher input costs everywhere. And it's been very sticky.
Yeah, another guest wanted to know, as a journalist,
yeah,
right? You've seen an awful lot of talk. You've been part of a lot of this talk, but the really good stuff. What guidance would you give us for how we separate the wheat from the chaff? And do you have a TikTok account that we can?
I don't have a TikTok account, but I am on Instagram, Facebook, Twitter. Yay. You mean in terms of what journalism to listen to or to read, or etc.?
How do we decipher with the information age? There's so much information out there. That's not the problem anymore.
Yeah, it's astounding to me to see the way we have become a country where it's actually very European, right? That we have outlets that are of one political ilk or another. That wasn't the way it used to be.
Sure.
So I think we all know the lens through which some networks and some reporters report, and you can use, I have a lot of confidence in the American people to be able to discern, okay, I agree with that, I don't agree with that, I understand why they're coming from that position and viewpoint. I like to read a lot of independent research reports. Between me and my husband, we subscribe to a lot of stuff. We read every morning. I read the Journal, the FT, the New York Post, which is just fun.
Between you and your husband, you guys just have
and the New York
stacks
Times. We do. We have piles of newspaper, but then we also subscribe to a lot of different services to read a lot more in-depth data than I think a lot of folks do, because that's what I do. I consume data, but I would read a lot of things. And then you can kind of discern, okay, the truth is somewhere in here. And also, the thing is, two people's truth can be, even if they're opposite, they can be their truths.
Yeah.
Their viewpoint is this. They've suffered this, and therefore, to them, that's the way it is. And, it's I think if I could go back to, I think what the big failure covering the election of 2016, the New York Times admitted that they had failed because they didn't believe that Trump would win. They didn't cover it as a possibility. They didn't cover the people who supported him in a way that I think was authentic. So they were surprised, right? And they felt bad that their readers were surprised. And I would say we just don't talk to enough people often. CNBC went out to the oil workers, coal workers, etc. I had a producer come back over and she said, Michelle, I think he's going to win. Really?
Everywhere we go, there's Trump signs everywhere and none for Clinton. And so, there were hints out there that it was going to happen. But if you were one of the major newspapers that never left, your urban center, you couldn't tell that story.
Yeah. Tony, let's return to the number one concern as we begin to head toward a close here of this group tonight, the impact of the presidential election on our money.
Absolutely. I do want to say one thing from a corporate perspective first. I think Michelle gave a great answer on the price gouging thing, but I do want to point out that corporate profit margins contracted. Like everybody in 2022 and into 2023, profit margins were contracting. So that's not price gouging, right? They're expanding again now, but they're largely expanding because productivity's been good. We are starting to see some pushback though on any sort of price hike. So I read about all these earnings calls. I don't know if anybody saw Starbucks. So the stock rallied, but the earnings were horrific. And why were the earnings horrific? Because volumes were down. It turns out that people don't want to pay $8 for a cup of Pike Place.
What?
So people are starting to push back against some of this stuff. I recommend Nespresso. If you for $200, you get a really good cup of coffee, and it pays for itself. But this chart is just showing the different political mixes. So Tim showed that long-term chart that it doesn't really matter the president's party, but maybe it matters if it's all Republican or all Democrat. And it turns out that it really doesn't. All of these returns are within a margin of error of each other for the most part. And I think Democrat Congress and Republican president was that hasn't happened very much. So, it's really, it's all really within a margin of error. These next 4 years are going to be dictated by many different things. Policy could be important, but I always like to remind people we're not invested in the Republican Party or the Democrat Party. I'm not invested in Nancy Pelosi, even though maybe I should be if you follow her trades on Twitter. I'm not invested in any of these people. I'm invested in companies with corporate executives. The job of a CEO is to maximize shareholder value. And I got news for you. They're going to do that regardless who's in charge. They're going to try to make money and maximize shareholder value. And that's what we've seen through time. And they're very good at adjusting to different policy mixes.
That's what we've seen through time. Explain this chart to us, Tony. This is like your favorite new chart.
Why did we put these small guys? I'm sorry. We'll just need to get you these slides.
This is what happens when investment specialists put presentations together.
I see them very clear. But so all this is showing is really we like to say there's 4 things you can do with your money. You can grow it, protect it, give it, or live off of it. And those are the 4 things you can do with your money. And with your money that you are growing for future living or giving, it pays to be an equity owner. So all we're showing is stocks with different starting years across the top. And then the annual return down the y-axis had you started investing in that year. So the way to read this is the first column would be 1993. 31 years later, your annual return was 10%. What is absolutely incredible is across the bottom how consistent it is. 10%, 10%, 10%, 10%. The red boxes are the absolute worst time you could have started investing. We're talking about the peak of the tech bubble in 2000. We're talking about 2008. We're talking about COVID on the far right side. And in all of those cases, once you get beyond about 5 years, guess what? You're positive again, and you're compounding capital at positive rates of return, and your long-term return ends up being about 10%. Now, we have to give, like, I don't know if compliance is the room in the, like, if like historical performance, future results, that kind of thing, that kind of disclaimer. But this is pretty powerful. So with the money, regardless of the message here tonight about the economy, the current state of the economy, politics, deficit, what have you, with your grow capital, you should be an equity investor, and that's what this tells us.
So part of the message here you can see, at least from an investment perspective, is stick with the plan. But I was talking to Jennifer Stevenson, who's here with us tonight, our Chief Planning Officer. You should corner her after we close out here and enjoy a drink with her and ask questions about what she's anticipating as it relates to many other policy potential moves, right? We talked about capital gains tax, the potential for Roth conversions in the future. Maybe the Roth IRA will go away completely. What about estate tax, inheritance tax? These are all very, very important things to consider. And we keep our pulse on this. However, we do not believe that in most of these cases, they are actionable until it actually becomes reality. So I want you to know that we are constantly looking at this stuff. We are keeping an eye on what is likely to happen. And then we will make recommendations. Your advisors, our planning department, will make recommendations as and when changes actually take place. Is that fair? All right, Michelle, I'd love a final word from you. Tony, I think you got your piece in there.
So I would just add, I know there's a lot of consternation right now because of the election. And I think, why are we so divided and what's going on? I would just, to try to make us all feel better. I don't know if maybe you don't feel bad, but the whole world is like this at the moment. So, Germany just reinstated borders. Do you know this? They're doing border checks. That was the whole dream of the European project, right? Was to not have borders. They just surveyed the French. 77% of French people want their borders back, right? I mean, there's all of this, I think, rebellion against what we thought was going to be this kind of, the free movement of labor, capital, and goods around the world was inevitable. Yeah. And maybe it's not. And so we're going to live in a different world. And the whole world seems to be on board with this idea at the population level. We're going to have more elections this year than any other year in history. It's a great year for democracy. And people are making choices about it. So we shouldn't, it's not just us. We're all kind of grappling with the changes that are coming because the Chinese economy isn't doing what it did, because interest, money isn't as cheap as it used to be, but we're going to get through it. Just watch this chart.
Well, isn't that the amazing thing that with all of this change and with the drama around the world and throughout history, much of this history and beyond, if we go all the way back to 1926, the inherent adaptability of the U.S. economy and the global markets is something that fascinates me. In this past weekend's Wall Street Journal, one of my favorite investing commentators, Jason Zweig, paraphrased Warren Buffett, who was paraphrasing his mentor, Benjamin Graham, when he wrote, "Investing isn't about mastering the markets, it's about mastering yourself." Indeed, this may be the biggest lesson for all of us to hear tonight, that when you have a carefully crafted portfolio and financial plan, it is often not what's going on out in the world that causes us to change course. It is instead your personal direction in life, your priorities, and what's most important to you. We call that net worthwhile, and we consider it our duty, indeed our calling, to help you grow, protect, give, and live, as Tony said, in a way that is worthy of your highest aspirations. I'd like to thank our CEO, Heather Robertson Fortner, and the board of SignatureFD for choosing to invest their time and effort in this night to ensure that you, our clients, and many of their friends, know that we are here to educate and support you through times of volatile interest rates, sustained inflation, contentious election cycles, and whatever else the world throws at us. And of course, you know that your advisory teams are your first line of defense for any and all questions that you have. I'd like to thank our friends here at the Ansley Golf Club and our internal team who lovingly crafted this event, Crystal Mathis, you'll see her walking around somewhere, and Samantha Geyer. And while last but certainly not least, would you please join me in thanking our esteemed panel for sharing their wisdom and insight tonight. All right, thank you guys so much. We're going to turn the music back on. I believe the bar is still open, and we look forward to talking to you and answering any questions you have.